Hello folks, and welcome back to another financial news crypto video. And today we have a very few we have a few very special topics for today. We are covering the daily news of today. And that includes we have four key things that we're gonna cover, and I think it's gonna. I only have four. There's a lot that happened today, but I'm gonna stick to four because I think it's gonna take me an entire video's worth, like 30 minutes, to talk about it all. But we're gonna get started, right? So the significant regulatory moves and institutional expansions that are dominating the crypto landscape today, April 7th, 2026. I felt that these four that I've chosen were the most, and the most impactful news involves a major shift in the U.S. regulatory policy and the introduction of new institutional trading products. Okay, so this is the first one I mentioned. This is a huge big one. So this was regulatory. The SEC just moved forward, and they're proposing a bill right now with regulation crypto. So the U.S. Securities and Exchange Committee, which that's what SEC stands for, which you should know by now, I believe. If you don't, there you go. Under Chair Paul Atkins, has officially sent a comprehensive regulation crypto proposal to the White House for review. So the goal and the proposal of this bill aims to clearly delineate which digital asset transactions are considered securities and which are not. So like this is a huge controversy whether or not XRP is like a security. And I think there was like a huge court case on that. I believe I don't know if it's still going on, or not. I believe they won it. I believe the XRP company. I don't remember which company. I'm not familiar in it. I just remember hearing about it. But they had they won their case whether XRP was a security or not. I don't remember if it was decided. I think they were fighting against it, that it was not a security. I don't remember. Okay, if you want to know about that, that's something you should search up yourself, or maybe I can say it at the end of the video. But anyways, we're gonna move on. So essentially, it's basically to decide and make known which digital asset transactions are considered securities or not. So the innovation exemption, which is a part of it. So the SEC is also preparing to release an innovation exemption, which is essentially a regulatory sandbox designed to allow startups and incumbents to experiment on chain assets under a protected framework. So basically like monitoring, but they give security with it, like for new fresh cryptos or new startups to get started. You know what I'm saying? So it's sort of like a sponsorship, but controlled by them, if you know what I'm saying. And then Senator Bill Hagerty had announced today that the Clarity Act, a key piece of crypto legislation, may be moved to a full Senate vote by before the end of April. And this comes from the sources of PyMints, PYNTS, The Block, and CoinDesk. So that is the first thing we're going to cover today. I'm going to get to that. The second thing we're going to cover today is the CME group. They're expanding their derivatives suite. So the CME group, which is the world's largest derivatives marketplace, announced today that it will launch Avalanche, AVAX, and SUI futures on May 4th, 2026. So the market impact of this is the launch will include both standard and micro-sized contracts, signaling growing institutional demand for diversified crypto assets beyond Bitcoin and Ethereum. Now there's already different and lots of diverse crypto assets beyond Bitcoin and Ethereum, but that's like the big one. Everyone focuses on that. So like minor ones, and it's not exactly minor in the sense that it's like it's not impactful, but ones that aren't like I mentioned this a lot. And I'd say about 1 in 10 people know about Bitcoin. Almost everyone knows about Bitcoin since it blew up. I don't believe it blew up in 2009. 2009 was when it was created, right? I don't know when it blew up, but Bitcoin blew up, and so now it's like when people think crypto, they think Bitcoin. When people think crypto, and they actually like not know about crypto, but they actually like they've looked at it like once or twice, they'll know Ethereum too. Ethereum is like the little brother of Bitcoin. It's always thought of second, but Bitcoin comes first, right? So people always think of that. So this is basically to diversify the crypto assets beyond like the big two, Bitcoin and Ethereum, and this comes from the sources PR Newswire, and the CME Group official statement. Now, the number 3 topic that we're going to cover today is market trends. So there's a silent migration of traders. So A new report released today by the digital asset tech firm ChainUp reveals a major shift in user behavior. So a key finding is that 60% of active crypto traders have changed their primary exchange platform in the last 24 months. The trend, the report on that trend highlights that traditional brand loyalty is collapsing, with 99% of traders surveyed saying they would switch platforms for even marginal improvements in transaction speed or token availability, which makes sense. If one store is selling something for $2 and another store is selling something for $1.59, and I really need that much. No, I'm gonna make it simpler. This is not $1.59. Let's not 1 cent it. Let's say a different store is selling it for $1.50. I'm gonna start shopping at the store that sells the stuff for $1.50 and the store that sells for $2 because I'm saving myself 50 cents. It doesn't matter to me which stores. Unless it's very rare, unless it's the company, let's say you're huge in XRP, right? You love XRP, you love the company, and the XRP company comes out with their own trading platform for using XRP. You might stay loyal to it because you like the company. Same with the store. Let's say you like the employees or you like the people who are running the store. Maybe you'll stay loyal to it. But majoritively speaking, the majority of people are going to do what's best for them. They're going to look out for number one. And if looking out for number one means switching platforms for better gains, that's what they're going to do. And that's basically what this report has found out. So that comes from Newswire. That information comes from newswires.ca, ChainUp Exchange Operators Intelligence Report 2026. Now, the fourth thing that we're going to cover for today is technology, the quantum threat to speed. So, a new research published today highlights a looming dilemma for high-speed blockchains like Solana. So, the trade-off is that implementing a quantum-safe cryptographic signatures meant to protect against future quantum computer hacks could reduce transactions processing speeds by up to 90%. So, right now, transaction speeds can be from 1 second and 10 seconds to 3 minutes, right? Incredibly fast compared to the banking system, which could take up to 3 business days to get your stuff done. So it's already really quick. However, if we want to protect our stuff from future hacks, right, from crackers and whatnot, you're going to want some kind of security system. Now, blockchain is already incredibly good in terms of security and encryption, but it's not perfect. A quantum-safe cryptographic signature could lead to getting closer to that perfection. Not completely, but getting much closer than blockchain technology already is. And so, by doing that, it would reduce transaction processing speeds by up to 90%. And so it would slow that 3 minutes to perhaps maybe an hour, maybe 2 hours. But the whole point of using blockchain technology is the speed, right? So it's kind of counterproductive, right? We're using, I believe it'll still be faster than banking system. But the whole point of using crypto is that it's fast. Well, not the whole point, but a majority, a big part of using blockchain technology is that it's much faster than the old, inadequate, and unupdated systems like the banking system currently, which is why even some banks, as I covered in my last video, if you didn't check that out, check it out, please. Gotta plug. Where was I? Right. Why, as I covered in my other video, banking systems are switching over to blockchains and cryptography and currencies and crypto technology. So the challenge is that networks may soon have to choose between maintaining their high throughout competitive edge or future-proofing their security, as I just mentioned, and this comes from the source, the Quantum Insider. So, also real quick, a current, where is it? The current market snapshot as of 4:30 p.m., which was a few at the time of recording this video, it's only been 25 minutes since then. However, when you watch this, if you watch this, it'll probably have been around 4 hours. If you watch this, 4 hours, 10 hours, etc., etc. Unless you watch it really late, then it's probably a few weeks ago, because I'm assuming that's the only way you're seeing this video. So anyways, Bitcoin, in the 24-hour change, it went up by 74%. It's now at $69,000 and $369. Ethereum at $2,115. So it went up by 0.39%. And then for those of you who are into it, Dogecoin, DOGE, went down by it went negative 1.85% change and went down to 9 cents. With 0.05 after the 9, right? This comes from the sources of real-time exchange data, April 7, 2026, Pin 2 News. Nothing too important, but those are 3 very popular coins. So if you're into crypto, you may or may not be into them, and it's just nice news. You probably saw it already, but anyways, so We're going to expand on the first one that I mentioned, and that is the biggest topic of the day, the regulatory SEC, which moves forward with the regulation crypto bill, right? So we're going to go on that. So the regulation crypto assets proposal represents a fundamental shift in how the U.S. government treats digital assets, moving away from regulation by enforcement toward a structured legal framework, right? So as confirmed by today, April 7, 2026, by SEC Chair Paul Atkins, the proposal has officially reached the White House Office of Information Regulatory Affairs, right? So this is the final internal review step before it is published for public comment, obviously. And so essentially, as the government and different systems, government banking, basically all of them, I'm just going to collapse it all to keep it simple. We're going to collapse it all into the government. The government has been, for years now, trying to figure out a way to get at crypto, right? Get at crypto, control it. They can't quite control it. So part of the government is working with it, now incorporating it themselves. And so this is an example of getting at crypto. I wouldn't say getting at, but it's like they're trying to piece it. The government is one piece of the puzzle, the people are another piece of the puzzle, and crypto is another piece of the puzzle. Now these are irregular shaped pieces, so the government is essentially trying to, like an inhibitor, get in on that enzyme and make it shaped differently. You know what I'm saying? So this is one of them, especially for like taxes and whatnot. How are they going to approach it? So to get to the first point of this, there's three pillars of regulation crypto. So the framework is designed to give crypto projects a runway to decentralize without the immediate threat of SEC lawsuits, right? So just like I believe, yes, this was the SEC ran into a lawsuit with XRP, which the XRP company, whichever company runs XRP did. I think it was Ripple. Yes, I believe so. Ripple had run into that SEC lawsuit, and I'm pretty sure this is where this lawsuit is mainly coming from, but there's other cases I'm sure of this too. So it features three specific safe harbors. So the startup exemption. Early stage projects can raise up to $5 million over a 4-year period, and during this time they're exempt from full securities registration, but must provide principles-based disclosures, which is basically being honest about their tech and team, right? So the fundraising exemption. For a more established project, it allows for up to $75 million per year fundraised. This creates a middle ground between a private, friends and family, seed round, and a full-blown public IPO, right? Then the next thing is the exit. The third pillar is the exit safe harbor, and this is the most revolutionary part because it provides a legal path for a token to stop being classified as a security. So if a project team steps back from managerial duties and the network becomes sufficiently decentralized, the token can then transition into a different regulatory category, like a digital commodity, and that allows for greater liquidity, etc., etc. So basically, the coin as while considered a security or has the potential to become considered a security has very low potential. By allowing this, it's going to increase the potential of the currency exponentially, as well as increasing chances for liquidity, right? And I'm not going to get into that. I'm not too familiar with liquidity and topics like that. So what the information is what you do with it. If you're familiar with that, that's great. If not, you should probably look into it better. But I'll try to explain it as best as I can. So number 2. The innovation exemption, which is the sandbox as mentioned earlier. Now, while the safe harbors focus on fundraising, the innovation exemption is a regulatory sandbox for trading and technology. So, it'll have controlled testing, which means it allows firms to issue and trade tokenized stocks or bonds on blockchains for 18 to 24 months with conditional relief from certain traditional rules. And then secondly, side-by-side trading, one of the core goals is to allow non-security crypto, like Bitcoin, and crypto asset securities to be traded on the same SEC-regulated platforms, which was previously a major legal hurdle. Now, this is very interesting, and you might be wondering why it's very interesting. I will tell you. Just give me a sec. And we're back, and I will tell you why this is very interesting. This rule, now I don't know if my notes didn't catch the specificity, or if there was a specificity at all. But it says the relief, right, the non-security crypto and crypto asset securities to be traded on the same SEC regulated platforms, meaning this does not apply unless my notes are wrong, unless my specificity is wrong. that they only any platforms that aren't regulated by the SEC, aka not regulated by the government, may run into trouble. So essentially, this bill, it's like you gotta look for these little things, because you see, it means that, as I was saying, the government has been trying to whack at crypto for a while, trying to find a way to control. This is one of those loopholes. Unless my information is wrong, which I don't believe it is. It could be. You should double check yourself. But I don't believe my information is wrong. I have the sources that I got it from, right? Meaning there's going to be huge problems that they're likely going to cause, or they could cause, for any platform that are not regulated by the SEC, right? Additionally, any SEC regulated platforms, that means it's not complete control, right? They don't have complete control over what people are doing, but they do have like monitoring of a sort of sense. You know what I'm saying? So it's attacking at that decentralization while sort of keeping decentralization. It's a bit iffy. Now, my explanation is not the greatest, I don't believe, right? And I could be wrong. But this is definitely something to watch for as the government tries to gain more and more control over crypto, as well, the government in general is not going to want something they can't control. Not totally. I mean, this is America. We do run on freedom, so of course there's freedoms, but some things, you know what I'm saying? It's sort of like yesterday as a concept. If like people found out, like if more and more people start finding out about like crypto and the blockchain technology, how to use it, and how they could get like transactions like this, and how it could cause bank runs, and people just immediately start pulling their money out all at once to head towards this. You know what I'm saying? So anyways, that's a huge, because of that rule, it's a huge incentive to get people to go towards more SEC regulated platforms rather than foreign platforms or less domestic platforms that are controlled by the government. So, and then number 3, for legislative context, there's the Clarity Act. So, while the SEC is moving on its own rules, Senator Bill Hagerty confirmed today that the Digital Asset Market Clarity Act is nearing a Senate floor vote. So, the tension. SEC rules can be changed by future administrations, but the Clarity Act would turn these protections into permanent law. The current status, prediction markets like Polymarket and Kalshi show a split in confidence, with odds of the bill passing this year hovering between 52% and 61% due to lingering debates over how stablecoins should be handled. And a key quote from SEC Chair Paul Atkins is that we can, quote, "We can do a lot regulatorily, but we just have to make sure it takes root and can't be done away with." Unquote, SEC Chair Paul Atkins speaking at the Nashville Policy Summit today. And the sources, this comes from Unchained, Trading View, DL News, Latham, and Watkins Regulatory Tracker. So, a little more about this is the movement beyond the regulation crypto framework, which progressed to the White House today, is essentially an attempt to formally end the era of regulation by enforcement. So here are deeper details on how the system is deeper to function, including specific safe harbors and the political friction surrounding it. Now this is interesting. Now, the end of the era of regulation by enforcement, I feel like it's a bit tricky. Because what do they mean by enforcement? Do they mean by law enforcement? Or... You know what I'm saying? So how do I explain this clearly? On one, it's like a puppet act, right? So there's enforcement by law, right? But there's also enforcement by certain controls, right? So I can enforce rules as a manager on my workers, right? Or like let's say I set rules, right? Then the workers are going to follow those rules. But let's say I want less enforcement. Since I'm the company owner, I don't really know the workers, I'll allow the managers to set the rules instead. So to the workers, that may appear as less regulation by enforcement, right? I'm not enforcing any rules. It's up to them and the manager. However, if I'm puppeteering the manager, as in I'm giving him those rules, then at the same time, I'm still giving the rules. It's just they don't realize it. You know what I'm saying? So that's a bit tricky. What do they mean by regulation by enforcement? So here are the deeper details on how the system is designed to function, including the specific safe harbors, political arrangements, as I said. So the token taxonomy and basically the foundation. So before this proposal reached the White House, the SEC and CFTC issued joint guidance in March 2026 to create a dictionary for digital assets. For the first time, the SEC has publicly moved away from everything as a security stance. The new taxonomy categorizes assets into digital commodities, e.g. Bitcoin, digital collectibles, e.g. most NFTs, digital securities, as in tokenized stocks, and digital tools, utilize tokens with no investment expectation. So, number 2, the safe harbor triple play. The core of today's proposal is to make a 3-tiered system designed to give crypto founders a legal bridge to decentralization. So this is actually depending on the motives behind passing this bill, this is actually going to be really good and as I said in the beginning, revolutionary for like different new creators creators that are currently in, right? Different companies, and businesses, etc., etc. Now, I know from the outlook, it's a bit weird with how my phrasing, because some of the phrasing seems like it's a bit weird, it's a bit negative, a bit anti, and then sometimes not negative, super positive, and I'm still getting used to that, right? So, well, not to justify myself. No, not. What's the word? What am I looking for, folks? What am I looking for? I'm like trying to be as little biased as I can. I'm just trying to put ideas out there. I'm trying to get you thinking. Now, remember, I just want to say this real quickly because I am putting out some ideas out there. I'm not a financial advisor, so you should not take my advice 100%. You should trust yourself. Just remember that. So, anyways, just want to add that in quickly. So, a core of today's proposal is a 3-tier system. So, the first, thing is the startup exemption. As I mentioned, the $5 million fundraising cap duration for 4 years, which is principle-based disclosure focused on tech and team. Then there's the fundraising exemption, $75 million a year, which is rolling, stricter reporting intended for scaling projects. Then there's also the exit safe harbor, which is not applicable to the fundraising cap, and the duration is permanent, which is allowing token is reclassified as a non-security once the team stops performing managerial duties, right? So let's get to the 3 points. So going more on the innovation exemption sandbox. So to explain it more, this is a separate hands-on program that allows traditional financial firms and crypto native companies to experiment together. So basically, the goal is to test if trading tokenized stocks or bonds on a blockchain actually improves market efficiency, which I assume, based on statistics, based on facts, based on what's happened, will actually prove to be more efficient, right? And then also the rules, participation is capped by a maximum number of users and assets under management from AUM, right? That was actually a quote. Quote, assets under management, quote, assets under management, unquote. That's from AUM. There's also the kill switch. So the SEC retains the power to revoke an exemption instantly if they detect investor harm, which some critics say creates a permanent regulatory overhang that might scare off big investors. Now, this is what I'm talking about. This is they're talking about exemption without regulation or regulation without enforcement or no regulated whatever. However, there's this huge thing, a permanent regulatory overhang, which is quoted, quote, permanent regulatory overhang, unquote, which could scare off big investors, because the whole point of crypto is that it's decentralized and it's controlled by the people, not regulated entirely, right? So number 4, the Clarity Act tension. So while Chair Paul Atkins is moving fast, he is in a race against the legislative clock, as Senator Bill Hagerty is pushing for a vote on the Clarity Act next week. So why does it matter? Well, SEC rules are administrative, meaning a future president could theoretically appoint a new chair who reverses them. So the Clarity Act would turn these rules into permanent federal law if it passes. If it doesn't pass, right, and it's just floating there, I mean, it could be filibustered, reverse filibustered, etc., etc. But anyways, let's say it gets let's say it goes somehow and it's not permanent, and then the next president comes in and puts in a new chair. That chair could reverse it, etc., etc. So that's why there's a rush. And then the impasse, the bill is currently stalled in the Senate Banking Committee for over a specific debate. Should stable coins be allowed to pay interest to users, right? Which, if it's still in the debate, I think they're going to go through with it, but there's a chance it could be filibustered. Who knows? But anyways, the current sentiment, so despite the progress, the market is very cautious. On prediction platforms like Polymarket and Kalshi, or, I don't know, is that a Chinese name? Because if it's not, it's probably called Shi. But if it's Chinese, it's called Shi, right? So the odds of the Clarity Act passing this year have actually dropped from 90% in January to roughly 52% to 61% today, as mentioned. So traders seem worried that the upcoming 2026 midterm elections will distract Congress before the bill can cross the finish line, right? And that source is SEC Gov, Unchained Crypto, DL News, and Invest. So now we're going to finally get to number 9. It feels like we started at 55, right? 455 is now 511. So 55, that's 5. So it's only been 16 minutes. Okay, we're making good time. We're making good time. This is definitely going to be around a 50-minute video, but we're making good time. So institutional, we're going on the CME group, which expands their derivatives suite. So there was an announcement from the CME group today, April 7, 2026, that represents a major milestone for institutional crypto adoption, specifically targeting high-growth Layer 1 blockchain networks. So by adding Avalanche, AVAX, and SUI, or Sway, if it's Chinese, SUI, to their regulated derivative suite, CME is essentially blessing these assets for use by major hedge funds, pension funds, and asset managers who are legally restricted from trading on unregulated offshore exchanges, right? So contract specifications and launch details. So the new futures contracts are scheduled to begin trading on May 4th, 2026, pending final regulatory review, right? To accommodate both massive institutional players and smaller prosumer traders, CME is offering 2 sizes for each. So the asset Avalanche AVAX, for the standard contract size is 5,000 AVAX. For the micro contract size is 500 AVAX. As for Sway, or SUI, SUI, it's 50,000 SUI for the standard contract size, and then for the micro contract size is 5,000 SUI. So essentially by micro, it's just 1/10. You get 10% of what the standard is, right? So why does this matter? Well, large contracts allow for massive hedging, insurance against price drops, while micro contracts allow traders to fine-tune their positions with less upfront capital, right? And then 2, there's a 24/7 trading, the no-sleep shift. So perhaps even more significant than the new tokens is CME's operational expansion. Starting May 29, 2026, the CME group will offer crypto futures and options trading 24 hours a day, 7 days a week, 24/7. And I mean, if it's 24/7, it's honestly 24/7, 365. Now, the only thing is, I don't know how it works. I believe it should be 24/7, 365. The question is, what about holidays? Is it going to be down for holidays? Like banks are, so that's gonna be interesting how people react to that, how they don't react to it, right? And how if the company is gonna keep it like that or not. So historically, traditional finance, TradFi markets, or TradFi markets close on weekends, leaving gaps in price when they reopen on Monday, often causing chaos for traders if crypto prices moved over the weekend. This move effectively synchronized the world's largest regulated derivatives market with the always-on nature of the crypto industry. So, being that, I'm assuming that I'm correct in saying that it should be 24/7, 365, right? Okay, so number 3. So, there's surging demand for market context, right? So, according to Giovanni Vicioso, CME, I believe I said that right? Giovanni. Is it Vicioso? That's very italiano. È molto italiano questo nome. Questo nome è molto italiano. Allora, quindi è Giovanni Vicioso. But it could also be Giovanni Vicioso. I mean, he's probably not going to see this video to judge me saying it wrong, but apologies if I said it wrong. So that's CME's global head of cryptocurrency products. So the expansion is a direct response to record-breaking activity in early 2026. So the volume, March 2026 saw a 90% year-over-year increase in average daily volume for crypto products. So the capital CME is currently processing nearly $8 billion in average daily notional value across its crypto suite. So essentially, it's at an all-time high. Activity is booming, and compared to the past few years, I mean, yeah, there's not much. It's self-explanatory. It's explicit. It says it itself. The productivity and the activity daily and average has increased a lot. And the ecosystem growth for AVAX and SWE as they join a rapidly growing list of institutional grade futures that already includes Bitcoin, Ethereum, and recently added Cardano, and Chainlink, and Stellar. It's like, yeah, there's so much just going in right now. Everything is moving. Crypto is on a move. It's like an exponential growth. It was slow when stuff started in 2009. Then with Bitcoin blowing up, it went boom, and it's been going up. It's been going up the exponential curve, and right now it's at its precipice. At its precipice in the sense that the mountain is still growing. The sky is the limit. In the sense that you go up to the mountain, that's the peak. Then you take a plane and you go higher and higher and higher and higher and higher. And then you take a rocket and you go higher and higher and higher. That's what crypto is going on right now. It's going on that grouping is building, and stuff's expanding a lot. And so the impact on assets like AVX and SUI, the institutional inclusion, which often leads to deep liquidity, which means that when a massive player wants to buy or sell millions of dollars worth of AVAX or SUI, the price is less likely to experience a flash crash or wild volatility compared to trading on smaller retail-focused platforms. And sources come from the CME Group press release, the PR Newswire, Bloomberg Terminal, and Blockonomy, right? So a little more on that is the CME Group expansion announced today that it's just adding a few new tokens. It's essentially a structural redesign of how Wall Street interacts with the crypto market. So by introducing of Avalanche and SWE futures and transitioning to a 24/7 trading model, the world's largest derivatives exchange is effectively erasing the opening bell gap that has long separated traditional finance from digital assets. So now they're going to be able to merge together. And then a deep dive into the new contracts, which is launching May 4th, is that CME is specifically targeting high growth, quote, high growth, unquote, layer 1 networks. So unlike Bitcoin, which is seen as a digital gold, quote, digital gold, unquote, AVAX and SWE are valued for their utility in DeFi and Web3. So Avalanche, these contracts cater to the subnet ecosystem and digital DeFi, and the SWE is a massive win for the Move language ecosystem, as SWE has gained significant traction in 2026 for its horizontal scaling. Now, number 2, the shift to always-on trading. So the most significant technical update is obviously the 24/7 trading. So the problem currently is when crypto markets go wild on a Saturday, institutional traders using CME are locked out until Sunday night, Monday morning, which creates a massive price gaps and high risk. Or massive, quote, price gaps, unquote, and high risk. So the solution starting May 29, 2026 is that they will trade these products continuously with only a brief 2-hour maintenance window over the weekend. So that if anything does change, it's not going to be as much as compared to, per se, a 24-hour. Because in 24 hours, a crypto could boom to thousands, and if you're on that site, oh my gosh, my nose is clogged for no reason. We're good, I think. Oh, ew. Did not even see that. So anyways, there's like a big gap difference between 24 hours and 2 hours. As 2 hours would hopefully allow people to get back in and react to any crazy changes, right? Which won't become crazy in time. So anyways, that's the solution. And the central logic is while trading 24/7, clearing and regulatory reporting will still follow business day cycles. Weekend trades will simply be dated for the following Monday. And then like a common question is like, why Avalanche and SWE? So CME doesn't add tokens lightly. They require deep liquidity and institutional soundness. And growth stats in March 26, CME's crypto daily volume was up 90% year over year, and $8 billion in notional value traded as recently. And recent precedents, these tokens follow the successfully 25/early 26 rollout of Cardano 88, Chainlink, LINK, and Stellar XLM futures. So these tokens are like they're on that ride. They're on the roller coaster ride. First ever, the roller coaster was just being done repaired, and the first ever ride is going super well, super fun, and everyone loves it for the first time. And these are the cryptos. These cryptos are the loving people loving the ride, and those tokens, Avalanche and SWE, were also on that ride. So they're gonna be the ones to tell everyone that it was great. So you said it's like a no pun intended, but like a chain reaction. Right? And then market sentiment, according to analysts at Volatility Shares, these products provide capital efficiency. by allowing institutions to cross-margin their crypto positions against other assets like gold or S&P 500 futures. And then the impact on market dynamics is that lower volatility. So when massive hedgers, quote hedgers, unquote, can enter a market, it usually damages the extreme pump and dump cycles seen on retail-only exchanges. And then leading indicators is that institutional, quote, open interest, unquote, the total number of outstanding contracts on CME is now considered a primary signal for where the smart money thinks the market is going. And that is, quote, smart money, unquote. Right? And then my sources are PR Newswire, we got the CME Group official media room, Chicago Today, and Bloomberg. Right? So that is essentially going to sum up for what's going on with the CME Group. Now we're going on to number 3. We're making good time. I believe I've been talking for 30 minutes now, which is a good amount of time. So we're going to go on to number 3, which is the silent migration of traders. As mentioned earlier, there's been a huge influx and change in where traders are trading from day to day, month to month, etc., etc. So basically, the silent migration of traders, which is a core finding in Exchange Operators Intelligence Report 2026, released today by ChainUp, describes a massive under-the-radar, meaning it's not spoken of, shift in how capital is moving across the crypto ecosystem. So as of April 7, 2026, the dash suggests the era of the loyal exchange user is effectively over, replaced by a mercenary mindset driven by pure technical performance. So essentially, it's like whoever pays the most, I'm going to, right? I'm not going to stay with this subscription. I'm not going to keep my subscription to Netflix if Hulu is costing me for less or YouTube is paying me for less, right? That's not the best because you're more likely to stay with a subscription since it lasts a month. But you get what I'm saying? If per se, if the dollar failed, right, or one day it was predicted it's going to fail, you're not going to keep your capital in the dollar because it's going to fail. So you're going to move to another currency. And it's the same with like stocks. I mean, if a stock is going to fail, you're probably going to sell. And you're going to go find a different thing to invest. And that's essentially what's happening here, right? So we're going to talk about the 60% shift. So the most striking statistic in the report is that 60% of active crypto traders have changed their primary trading platform in the last 24 months. So the silent nature is unlike a bank run where users withdraw funds due to fear. This migration is not driven by panic, but rather it's a quiet transition where users move their liquidity to platforms with better execution, lower fees, or broader token support. And so the zero friction threshold, which is according to CEO Sailor Jong, is that the market has hit a point where even minor operational friction, like a slightly slower UI or 30-second delay in price updates, triggers an immediate exit of capital, which is huge because that in itself can cause the bank run equivalent to websites. If people are withdrawing their capital, that's a loss of capital for the company who created the site, and a loss of capital for the company who created the site means they have to do something about whatever that is before eventually they either go bankrupt or they can't continue as a company. So anyways, the performance versus brand, the 99% rule is that report so the report that I was talking about that came out, right? It highlights a brutal reality for exchange marketing teams. 99% of traders surveyed stated they would migrate to a new platform for even marginal improvements in execution and utility. So hygiene factors. Features that used to be selling points, like 99.9% uptime, basic regular compliance, and security, are now viewed as hygiene factors. The new standard: traders no longer reward an exchange for being stable. They simply expect it as a prerequisite. Instead, they are looking for lifecycle ownership. Or no, not they are, but they simply expect it to be a prerequisite, right? So they are instead of that, they are looking for lifecycle ownership. So platforms that can grow with their needs, offering everything from basic spot trading to advanced RWA real-world asset tokenization. So number 3, the satisfaction gap. So ChainUp identified a growing disparity between what users expect and what current platforms offer, particularly regarding interface quality. So while UI and UX is a leading indicator of where capital will move, many exchanges are still using infrastructure designed years ago. And by years ago, it's not like it isn't recent, because like 2015 isn't like that long ago. It's only been like a decade and a year, right? But still, with technology advancing so fast, like even a month can be devastating if something isn't updated, right? Because new technologies are coming out every day. It's being worked on every hour. So anyways, the next thing is token availability. Traders are moving to new platforms that can list new high utility tokens like the AVAX and sway derivatives mentioned earlier faster than the competition, right? And then number 4, next point, is a strategic pivot from acquisition to retention. So the report serves as a blueprint for exchange operators in 2026, advising them to stop spending millions on flashy celebrity marketing and start investing in infrastructure depth, as in high-speed matching engines, 50K plus TPS, and AI-driven fraud detection. And then also compliance as a service, automated monitoring that doesn't slow down the user's trading experience. And then a quote from Sailor Jong, CEO of ChainUp, is that the market has reached a critical inflection point, or I should, hold on, let me say quote, the market has reached a critical inflection point where being technically sound is no longer enough to protect liquidity, point, unquote. And the sources: PR Newswire, Global FinTech Series, ChainUp official blog, and then Hipster, right? So I'm going to tell you a little more on that, on the silent migration, but first let me check my battery on my camera, because it was very low. I did not charge it, so I need to see that, right? Hold on. 33%. We're making good time. We're making good time, folks. We're making good time. We're making good time. Very good time. Oh yes, very, very good time. Okay. So, where was I? Silent migration. Right. So, it's not essentially a catchy. It's very catchy, but it's not supposed to be a catchy headline. It really marks the definitive end of brand-first crypto marketing. According to the Chain of Exchange Operators Intelligence Report 2026 released today, the market has entered a phase of hyper-rationality, where traders prioritize utility over everything else. So, here's a deeper analysis of the report provided. So, the depth of sticky users. For years, exchanges relied on the idea that once a user went through the hassle of KYC, know your customer, and deposited funds, they were likely to stay. And now the report that just came out proves that this is no longer true. So, the 60% stat. 6 of the active traders have changed their home exchange in the last 2 years. Oh my gosh, Mike. You can still probably hear me, but it wasn't facing away. Capital velocity. So the migration is silent because it doesn't happen during a crash. It happens during periods of growth, as traders move their capital to whichever platform offers the best plumbing for the next cycle. So essentially, it's not going to be big news that people are changing. They're doing this on their own. They're doing this because they want the maximum efficiency. So it's not going to be big news about it because there's no big news to cover when it's happening. It's like if everyone in a cafeteria likes the sandwiches better than pizza, right? They're starting to like sandwiches better than pizza because they're cooked better, and we're just gonna move to eating sandwiches, and the pizza's just gonna stack up. There's not gonna be any mention of it. Unlike if, like, let's say the oven broke and pizza couldn't be cooked, and then we all have to eat sandwiches, it's gonna be known why we're eating sandwiches. Otherwise, people are not gonna notice unless they notice like the pile of pizza not being eaten, right? So anyways, number 2, the hygiene factor shift. As ChainUp CEO Jong argues that the features once considered premium have now become hygiene factors, the bare minimum required just to stay in the game, right? So all differentiations: 99.9 uptime, basic security, and mobile app availability. So the 2026 reality, however, is that these are now prerequisites for entry. Traders do not reward an exchange for staying online. They simply penalize them for the slightest friction. And the zero friction threshold is that even a 30-second delay at price, as mentioned, updates or clunky withdrawal process, is now enough to trigger a total exit of capital. Number 3, the satisfaction gap. So the report identifies a massive disparity between what exchanges think they are providing and what users actually experience. So like interface versus intelligence. While many exchanges focus on a flashy UI, the report shows that traders are migrating towards platforms that offer life cycle ownership. And the life cycle ownership concept is that, which it means basically providing a platform that scales with the user, from simple spot trading to advanced institutional tools like RWA, tokenization, and AI managed portfolios. If a user outgrows an exchange technical capabilities, they leave. They're not going to wear the same pants if it no longer fits them, right? And then the number 4 point is that from acquisition infrastructure. So the strategic advice for exchange operators in 2026 is a total pivot. So it's basically saying stop spending millions on celebrity endorsements or stadium naming rights. Just because someone who's very popular is making a lot of money is saying something is good doesn't mean you should go to it. And if you ask me honestly, unless the person is stating facts when they're promoting it, then someone should not be going towards that anyways, because it could be a scam. Now, I'm not a financial advisor, so don't take my advice to heart, but I'm just adding in a little bit of logos. Forget pathos, because no one's buying stuff off of pathos. Come on, it's the ethos here. Ethos is the problem. Pathos is already gone. Get off the ethos. We need logos, and logo says if you should know your stuff before you get into it, right? That's just what logo says. Logo says it in logic. Now remember, I'm not a financial advisor. That is not advice. That is not a recommendation. That is just my thoughts. And so, people are starting to invest in high-speed matching engines, which are capable of $50,000 plus transactions per second, or 50,000 transactions per second, actually, not dollars, 50,000 transactions per second, and automated invisible compliance layers. And a quote from Sailor Jong is that the market has reached a critical inflection. I think I read this before, right? Which is no longer enough to protect the liquidity, unquote. And the sources are Chain Up Official, Hipster, Global FinTech Series, and PR Newswire. All right, so number 4, technology and the quantum. I don't know what that is. Like, you speak long enough, all your like mucus and stuff just gets clogged up here. I have no idea what that is. I need my nasal 4. Somebody got it, please. All right. And this is the final topic. This is the final thing. And I think we'll finish in the next 5 minutes, right? Or 8. So, the quantum threat to speed. So, the quantum threat to speed represents a major technological crossroads for the crypto industry. Because as of today, April 7, 2026, the conversation has shifted from will quantum computers happen to can our blockchains handle the weight of the cure? The core issue isn't that just that quantum computers could one day crack your private key, it's that the post-quantum cryptography, PQC, required to stop them is incredibly bulky and slow compared to the current standards. So, 1. The fat signature problem. Today's high-speed blockchains like Solana rely on a cryptographic method called ED25519. It is prized because its signatures, digital proof that you authorize the transaction, are tiny, only 64 bytes. So, the new reality is that new research from Project 11 and the Solana Foundation released this week shows that the quantum-resistant signatures are up to 40 times larger. Right? So that's the equivalent of comparing a doghouse to a hotel. I mean, the doghouse, you can quickly, if you put something in there, you're quickly grabbing it out. But if you put something in your room in a hotel, you're taking 5 minutes to check in. You're taking 5 minutes to go up the stairs, or maybe a minute to go in the elevator. You're taking 5 minutes to get into your room. You're taking 5 minutes to put your stuff down, and you're taking an extra 5 minutes to actually grab the thing that you were getting. And per se, you're not staying there, then you're actually grabbing the thing you're getting, and then all the time you just spent, you're doing it again to get back downstairs, and you're taking 5 minutes to get to your car, if you get what I'm saying. So that's the big thing about the 40 times larger. And then the bandwidth, the larger signature bandwidth tax, larger signatures mean every single transaction takes more space in a block. And for a network built on a fire hose speeds, this extra data creates a massive bottleneck. Right? So essentially, it's handicapping. It's going to be for the security it allows. Like, for instance, it's very interesting, right? So that doghouse and hotel analogy, all that time it takes to the hotel, at the least, you know your stuff is going to be there. Whatever you came for, whatever you're going to go, whatever you were going to get, it's going to be there in the room wherever you placed it. The doghouse, however, there's like, it's more than likely going to be there, because why would someone look in the doghouse, right? But someone could look into a doghouse, and someone could take whatever's in the doghouse, and when you come to get it, it might not be there. You get what I'm saying? So it's a risk and reward and risk. It's like, what do you want to do, right? And it's like there's a 90% performance drop, and that's like the most alarming news today, which comes from the Quantum Insider, and it details the recent stress tests on quantum safe test nets. And so there's a processing sum, which is because PQC algorithms like those based on lattices require more complex math. The time it takes a validated or verified transaction has spiked like a ton. I wouldn't say exponentially, but it spiked a lot. And the result in these controlled trials is that Solana's throughput dropped by nearly 90%. A network that usually handles 50,000 transactions per second struggled to maintain even 5,000 TPS, which is transaction per second, under full quantum safe protocols. So, and that leaves us to number 3, the harvest now, decrypt later strategy. While cryptographically relevant, unquote, quantum computer doesn't exist yet, today's report from S&P Global and Grayscale highlight a more immediate threat: harvesting. And what it is malicious actors in some nation states are reportedly harvesting encrypted blockchain data today, saving it in massive data centers. And the goal is that they are waiting for the day a quantum computer is powerful enough to decrypt that data retroactively, exposing old cold storage wallets that were never moved to quantum safe addresses, right? So there's a lot of exposing. Basically, anything that doesn't move with everything else is gonna be seen. If everything is in a boat, like inside a boat, you're not gonna know it's there. But if stuff is dropped off that boat in the ocean, everything's gonna see it. The fish is gonna see it. The sun's gonna see it. The sky's gonna see it. Birds are gonna see it. You're gonna see it. The boat's gonna see it. Everything can see it. And everything is going to know. But more specifically, only specific things in that area are going to know. So whoever is driving that ship is most likely going to be the first to see it, right? So, going on to number 4. So the proposed solutions for this is the hybrid path. To avoid a 90% speed penalty, developers are proposing a middle way, which is hybrid signatures, which means a transaction would carry both a traditional signature and a quantum safe one. Users could choose the express lane, fast but risky long term, or the secure lane, which is slow but quantum proof. Hardware acceleration. So companies like Microcloud Hologram announced a $400 million investment today to develop specialized chips designed specifically to crunch PQC math at hardware speeds, potentially negating the software slowdown. And quote from the excerpt is, quote, "We are essentially trying to put a bank vault door on a Formula One car. It'll be safe, but it might not win the race anymore, period, unquote," an expert from Quantum Insider's April 7 report. And our sources is the Quantum Insider, of course, Binance Square /NS3.ai, TradingView, Coinpedia, and Stock Titan, right? So, and this is going to be our final point. A little more on this is that the latest updates on the quantum threat as of April 7, 2026 has shifted from theoretical warnings to hard data from stress tests. And so the industry is currently grappling with a security versus speed paradox that could redefine the hierarchy of major blockchains. So, the 500,000 qubit milestone, a groundbreaking paper co-authored by Google Quantum AI and the Ethereum Foundation and Stanford University, was released recently, dramatically shortening the, quote, doomsday unquote clock. So the findings is that previous estimates suggested it would take 9 million physical qubits to break the encryption at ESDSA used by Bitcoin and or ECDSA used by Bitcoin and Ethereum. This new research proves that optimized circuits could achieve this with fewer than 500,000 physical qubits. Now, the timeline. While we aren't there yet, Google's commitment to transitioning its own internal systems to post-quantum cryptography, PQC, by 2029 has served as a wake-up call for the crypto industry. And that comes with source Blockhead, April 7, 2026. So, number 2 is Solana's 90% speed penalty. So the most discussed news in the developer community today involves a joint trial between Solana and Project 11. They tested quantum safe signatures in a live environment, and the results were, for lack of a better word, sobering, right? So signature bloat. Current signatures are roughly 64 bytes, and quantum-resistant alternatives, like those based on lattices, as I said, are up to 40 times larger. So the bottleneck is that because these signatures are so massive, they have significantly more space in each block, and require much more CPU power to verify. And so the result is Solana's throughput, usually its main selling point, plummeted by 90% during the trials. And this has sparked a debate as, is a safe blockchain worth having if it can no longer handle high-speed trading? And sources come from Quantum Insider and KuCoin News, April 5th, 7th, 2026. No, so number 3 is Microcloud's $400 million Bitcoin pivot. And so in a massive corporate move announced yesterday and gaining traction today, Microcloud Hologram, NASDAQ, Holo, has pledged $400 million to upgrade Bitcoin protocol for quantum resilience. And so the strategy is that they're proposing a hybrid dual signature design, which would allow Bitcoin transactions to be signed with both the current method, XDA, and a new quantum resilient one like crystals to lithium, right? So the benefit is that it creates security redundancy, so if one is cracked, the other holds the line, and also allows for a soft fork upgrade rather than a chaotic mandatory split of the network. And sources PR News and Stock Titan. So the Mo warning, aka the Mo warning, which is a question, is a new block size war. So not everyone is on board with a fast transition. Samson Mao, CEO of Jan3, issued a warning today that rushing to quantum fix could backfire, right? And so the argument is that because quantum signatures are so large, 10x to 125 times bigger, implementing them too early could reignite the block size wars. And the risk, Mao argues, is that we might accidentally make Bitcoin vulnerable to current computers by overcomplicating the code just to protect against future quantum ones that may still be a decade away. So essentially, we're preparing for a meteor shower by building, like a meteor shower that might not come for decades upon decades, right? By building like these things over a city, and inadvertently we're creating more problems. We're blocking out the sunlight, plants can't grow. I mean, blocking out the rain, etc., etc. There's so much. There's so much. So essentially, by preparing too early, we could be creating inadvertent problems that could lay to stay until it's been done. So anyways, the metrics, so signature size, the current standard, 64 bytes, and the quantum safe lattice-based standard would be 2,500 plus bytes, which is 4 times larger. The network speed would be 100% baseline currently, but thanks to the quantum stuff, it's negative 10%, which is a 90% reduction. I mean 10%, not negative 10%, about 10%. And the security status is that although fast, currently the regular standard is vulnerable to qubits, while quantum is quantum safe, lattice-based is quantum resistant, right? And these sources come from the Quantum Insider, Blockhead, PR Newswire, and KuCoin News. And that, my friends, my folks, no. That's a bit weird. We don't even know each other. Okay, so my friends, I think it could be used. My folks sounds weird because I don't think in the history of humankind anyone's ever said that before. But the way. Well, folks, that's what I mean. Well, folks, this is where we're gonna end it today. That's about all the news for today. We covered the 4 different things. We covered the what do you call it? We covered the thing that was passed by the SEC. We covered the CME group expanding their derivative suite. We covered the market trends, the silent migration as mentioned, and finally we covered the technology with quantum touch speed. Information is what you do with it. I am not a financial advisor, as I said, so you shouldn't take my words seriously. You should always fact check. But yeah, that just about covers all the news for today. I hope you enjoyed. I hope this was informative for you. I hope it was also entertaining because no one wants to watch a 50-minute boring video. Yeah, and that is where I will conclude for today.